This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to another episode of Bank Nerd Corner, everyone's favorite podcast, a podcast that is not too long, despite what some of its hosts and co-hosts may sometimes feel. I am joined by my delightful co-host for this podcast, Kiah Haslett. Kiah, how are you?
Hey, good. How are you? Did you have a good Thanksgiving?
You know, it was good. It was good. My brother hosted it at his house, and it was his first time hosting Thanksgiving.
Oh my God. Did you give him feedback at the end of the evening?
You know, the feedback probably was more appropriate to give to my parents because they did most of the actual work. He more was just providing like a house for all of that work to happen in. So we sort of had to divide that up. But I thought he did a good job, like the social aspect of hosting and making sure everyone felt comfortable and kind of trying to mix all the different groups because there were some friends, there was some of my wife's family, there was my family. So it was kind of a whole combination of things. There were lots of little kids. So it was good. It was a good event. How was yours?
It was good. I went to Atlanta to hang out with a friend whose husband is in residency and was going to be working most of the weekend. I had like a pretty hot take, and I see you're wearing a hoodie today. I mentioned that I don't like hoodies, and I don't think people should wear hoodies. But someone and it was most of the people at this Thanksgiving were wearing casual to business casual clothes, which I have also separately said I don't like at Thanksgiving.
Right. That's another hot take.
Right. So no hoodies, no business casual at Thanksgiving. But someone at that Thanksgiving was wearing a hoodie and heard me say this, and I had to eat it so bad. Like normally I just get to make my little funny jokes on Twitter and then not have to look anyone directly in the eye when I'm making it.
So did you make this joke at the dinner too, or did they see it on Twitter?
It was like after dinner. Like it was like a living room, dining room situation. I think I have a voice that people can hear really easily.
I think that's true.
But I did hear, other than the person being really miffed, potentially, lightly
little
offended,
upset, maybe. Yeah, sure.
Everyone else was laughing, and I heard later that was the highlight of Thanksgiving. So everyone is welcome that I provided the hottest take of the evening.
Very nice. Very nice. Just in brief, summarize your argument against hoodies.
So I think, one, people have too many of them. And I think in general that you don't need as many hoodies as you accumulate.
Okay.
Two, I don't think that design-wise, the hood plus kangaroo pocket combination is one that is utilized to its fullest extent, that it justifies having it. Most people, if you need something on your head, you could wear a coat that has a hood, or you could wear a hat that has a hood. You don't need to wear this sweater that has a hood. The other thing too is I think because you put your hands in the pockets and then you probably like pull your hands down, it actually totally unshapes the hoodie. I was doing some research on the history of hoodies. It looks like they are often oversized because you would wear like your football pads underneath and then go outside and warm up. And then you would take off your hoodie when you get warm. And I'm just going to go ahead and say like 98% of hoodie wearing is not related to like wearing your football pads and going outside and working out. And actually, as someone who has to run outside when it's cold, I have this actual distinct problem, but I managed to avoid it wearing without pullover hoodies. I think zip-up hoodies are fine. I think you don't have the like structural problems. And I also think they're a little bit closer to jackets. I also think I've been overexposed to the Midwest culture of wearing a hoodie when you should be wearing a jacket. And that personally infuriates me. So I would just encourage, like, you don't have to abandon your hoodies, but try to like go without wearing them for a month and just see where you end up gravitating towards. I think sweaters are underrated and sweatshirts are underrated. Cardigan for men, try it out.
Sure. I like a cardigan.
Yeah.
I like a cardigan.
So that was my I know we're not going to try to take an hour, but I just took a couple of minutes to piss everyone off on this podcast.
Well, I mean, like Kiah's fashion corner is probably like another segment we'll need to add to this, because you have a lot of like sartorial thoughts, which I didn't necessarily know going in.
I don't think I knew that about. What I don't think I knew is that my opinions are not shared by everyone else. And so when I share them, they get some responses that people get in their feelings about stuff.
I mean, people have strong feelings about outfits in particular. So on the hoodies thing, I'm with you, I think, generally. Like, I love a zip-up hoodie because, like, the
Oh,
pockets make
underrated.
sense. Yeah,
Yes.
like, if you're wearing something that's cool underneath, you can kind of show a little bit of that. You can, like, do a layering effect. So I like
Totally.
that. The one thing I'll say, well, the other thing about hoodies that's kind of weird is I've never been a big fan of the like wearing a hood for warmth. Like if it's cold, and this is
Okay.
maybe a Montana thing, but you wear a hat, right? Like if it's cold, you
Yeah.
wear a hat, and if you don't, you just don't need anything. Like the hood as a way to keep warm has never made sense. Now it can be like
hmm
a look or a fashion or a style, but like as a way of doing that, that's never made a lot of sense to me. But the one counterpoint to all of this is I swear, some of the most comfortable, like warmer clothing, they
Yeah.
just happen to make as sweatshirts. And so it's kind of a problem with the manufacturing where it's like, this is like the softest material. It has a
hmm
really cool like design on the front. Like they put a lot of energy into making hoodies desirable. And so I'm not with you. I think they should do that, but they need to like direct their energy elsewhere because some of my favorite clothes are hoodies, not because they're hoodies, but because of other attributes. Does that make sense?
Yes, but I think sweatshirts are going to really scratch that itch for you. I think sweatshirts are really close to being a hoodie without having the hood and the kangaroo pocket, and so they fit a little bit better. You can even you have more space on real estate on the front to put like cool designs.
Designs, yeah.
Yeah,
Okay, so
yeah.
sweatshirts, this sweatshirt concept you're
Mm.
talking about. All right, I'll
Yeah,
look
look
into
it up.
that. I will look into that. All right, we've definitely blown through our budget for small talk at the beginning of the podcast. As always, we are going to recap a few headlines from the last month or so of banking news since the last time we spoke, and then we'll get into some sort of questions that we have. Kiah, are you ready for my first bit of news?
Yeah, hit me.
Okay, this is a little bit more on the fintech side. So this is Kiah Haslett, fintech editor, not Kiah Haslett, banking editor. Though banks are very happy about this
I think
news.
we'll talk about banks later, but yeah,
Yes, we
let's talk
will.
about some
We
fintech
we
stuff.
have some bank stuff coming. So on the fintech front, the CFPB proposed new rules that would allow them to oversee big tech companies and other providers of digital wallets and payment apps. So for some background, under Dodd-Frank, the CFPB has the authority to supervise non-bank entities that are considered to be, in quotation marks here, a larger participant of a market or other consumer financial products or services. The CFPB has been pretty aggressive in using this authority to essentially kind of ring fence and bring into the regulatory perimeter large participants in other areas of the market that they feel have a significant role to play as it relates to the potential for consumer harm. So this has included the consumer reporting industry, as the credit bureaus well know, consumer debt collection, student loan servicing, and international money transfers. So the, I guess, fifth of those sort of large participant categories that they're going to carve out some room to supervise is going to be big tech companies and providers of digital wallets and payment apps. So essentially, the proposal would apply this label, this larger participant label, to any non-bank company that facilitates more than 5 million payment transactions per year. And these entities would be subject to the same supervisory examinations that banks and credit unions and those other large participants that I mentioned before are subject to. As I hinted earlier in my introduction to this topic, banks were very happy about this news. I think you could probably comb through the entire history of all of the press releases that the CBA, Consumer Bankers Association, has ever put out, and you could count probably on one hand, maybe not even with that many fingers, the number of press releases that were positive about something that the CFPB has done. But this was one of them. They were thrilled that the CFPB is going to be trying to level the playing field and put some more scrutiny and regulatory work on top of these large non-bank providers. However, fintech companies and big tech companies were not as happy. Some of them are already being supervised by the CFPB. So
hmm
companies like a Block or a PayPal, they're already being supervised by the CFPB, I think under the international money transfer sort of exemption that they've already carved out for themselves. But it's been reported in the news that this would bring an additional 17 companies into the fold for ones that would be facing scrutiny from the CFPB. That would certainly include companies like Apple and Google, who I think are
hmm
pretty central to the target that the CFPB has in mind here. But it would also likely include some companies, like, for example, they talk specifically in the proposed rules about crypto. So I think any company that facilitates either P2P payments or using crypto as a payment mechanism would be included if the number of transactions was high enough. So think someone like Coinbase. I'm a little unclear still if some of the pay in four, buy now, pay later providers like a Klarna or an Affirm would be included. My hunch would be that they would be. And then I think if you were to stretch the definition of wallet that was in the proposal, and I read the proposal last night, or at least large chunks of it, you could, I think, make the argument that it might include some infrastructure providers that are playing sort of a somewhat customer-facing role in facilitating stored value payments. So think about like bank-to-bank payments via something like Stripe Link, or maybe even Plaid, or smaller sort of wallet as a service provider, someone like an Anza. So I think it's possible it could extend that far. I did get confirmation that it will not include Delta Airlines and their mileage program. It does not include Starbucks, which is everybody's favorite example of a bank that's not a bank. So it does definitely draw some lines around who's not included, but going to bring some new companies in. And I guess my question for you first, Kiah, is what do you think about the CFPB sort of adding these companies to their list of folks that they're going to be regularly supervising?
I'm pretty interested in this, maybe not in the actual specifics of the proposal itself and your work to figure out who's supervised and not supervised. I am really interested, and congratulations to CFPB for figuring out how to supervise companies that don't have a bank charter and have figured out kind of the back door to supervision, which is, banks get to make payments, and banks have all these privileges associated with payments, and they get to make money off of payments, and they get all this data from payments. And the supervisory parameter is very clear for banks and who supervises banks. And it has not been clear for some of these pretty big companies.
Yeah.
So, and it's funny to think that, like, man, is this how crypto gets regulated? If they can't get the SEC and the CFTC to agree on anything, is it a commodity? Is it like a security? I don't know. It's a payment.
They're making payments, right? Yeah.
So
You're
on that.
If you have the ability to send crypto, they were very specific about defining funds in the proposal, and funds is not like dollars. It's any type of stored value for a consumer. And so they specifically did lump crypto in.
Yeah.
And, if you're providing an app that allows you to send crypto to someone else, so P2P payment functionally, you'd be included if you're above that 5 million transactions a year threshold.
Right. And so it's just, I think there's always been kind of like, remember Google was going to have like a bank account or a Google wallet that was going to be powered by banks. Amazon has there's always been concern about Amazon getting a bank charter. There's been concerns about non-banks like Walmart getting a bank charter.
Yeah.
And I think, some of those efforts have been blocked by the banking industry. I think some of those efforts, it has been shared that you really don't want to be subject to the Bank Holding Company Act if you're not really wanting to be a bank. And so it is just so interesting to think about this activity, the facilitation of this activity that actually has been pretty dominated by non-banks and as being the back door for the regulation. And I'm kind of like, I don't know exactly what CFPB supervision is like and how it differs from the prudential bank regulators supervision. So that's going to be a really interesting distinction. But it is funny to think that oh man, I don't know if you guys knew when you were starting these payments facilitation for customers, what that down the road you were going to be subject to the CFPB. And I don't know if they would have made a different choice knowing what they know now.
Yeah, well, I'm glad you brought that up, actually, because that was my number one takeaway from it as well, is payments specifically is one of those areas that's kind of funny because from a bank perspective, it's, oh, hey, what a great source of non-interest income, right? And so, we can collect fees, we can process these payments, it's transactional, we can sort of try to optimize our stack in order to generate the most profits possible. I mean, it's a very nice hedge against sort of macro conditions. And so from a bank perspective, it's just another business that's kind of a nice part of their diversified business model.
It's one of the three things that makes banks special is the facilitation of payments.
Yes, exactly. So from a bank perspective, cool. We understand the value. I think people don't necessarily spend a lot of time thinking about what the value payments provides to non-banks, right? Because the one thing with payments is it's not the like highest margin business in the world. And so if you are in the business of facilitating payments and you're not a bank, obviously you're still working with a bank to do that because you have to. And it's likely, if it's running on the card rails, that you might have other mouths to feed involved in that process as well. And so you're already sort of dividing up your margins in a way that's not going to be crazy attractive. So it's usually not primarily a moneymaker. The money is nice, but like when I look at big tech companies and their strategies around payments, it's much more about, hey, can we have someone just glued to their device all the time? Can we make our ecosystem and our products that much more engaging and that much more important to our consumers' lives? And in driving that engagement with consumers, can we generate a lot more proprietary data, which we can then use to do all the other things that we do, whether it's lending or, trying to do like advertising. I mean, you mentioned Amazon before. I was trying to think about if Amazon would be included in this. And the conclusion I came to, at least, was I think they probably will, not because of a specific like digital wallet that they offer to consumers, but more because of the Amazon Pay button that they enable and allow other merchants to take advantage of. That's a stored payment credential that they manage on behalf of their customers that's going to be used to buy things from other merchants. That would be included in this, right? And so I think, if you were to ask someone like an Amazon, like, hey, would you have done, Pay with Amazon as a mechanism to sort of further spread your tentacles out outside of your own walls and generate more data and maybe use that to spin up your advertising business, which is now a very profitable part of Amazon's overall business? They probably wouldn't have said yes if they knew it was going to come with this level of supervision. So I do think it might sort of shake up the Etch-a-Sketch there a little bit in terms of like, if you're big tech and you're thinking about payments, or you're a company that's looking at like embedded payments or embedded finance, this might change the calculus a little bit.
Yeah, it is kind of interesting to think that payments for non-banks has been just feels like kind of a gimme. And now there are kind of some regulatory costs associated with it. I don't know. Also, once the CFPB gets into your non-bank, I don't know kind of where the supervisory parameter then ends.
I'm so glad you mentioned that.
Look at,
yeah,
right?
The first of probably many analogies that I'll use, but like it's very like law enforcement with exigent circumstances where it's like, oh, hey, someone called 911. We're going to have to break down the door to this house. And then as you go into the house, you see, hey, there's some cocaine over there. And there's a firearm that I wonder if it's licensed properly.
Yeah.
And you see all these other things that weren't the reason that you were able to go in. But once you see them, then you have the ability to take action on them. And the CFPB did specifically talk in their proposal about UDAP is going to be like one of the things, obviously, that they focus on.
Yeah.
And UDAP is like a very broad tool, right? And so that's the other thing I would be concerned about if I was these big tech companies is if you're doing other non-paymentsy things, but that might generate some UDAP concerns, it's not like outside the realm of possibility that that's going to end up sort of getting swept into this as well. And I think this ties into one other area that I've noticed with the CFPB recently, which is they've been doing a lot of things, like, for example, around the use of like big data and algorithms for underwriting. So they're all about like AI and big data and, surveillance capitalism and all of these things. And they always sort of link it back to the data that big tech might have on you and how they use that to make decisions about you. And most of what they've done so far has been, well, we're going to send these companies some questions. We're going to poke around here. Maybe we're going to have non-bank lenders, be more specific in their adverse action notices, which is something that we talked about last time. But it has always felt to me like sort of a way for the CFPB to go, we don't know what's going on inside these companies, but our suspicion is there's bad things happening. And so we need to find kind of clever ways to sort of try to generate evidence that bad things might be happening that might allow us to kind of dig in further. This is a different way of doing that because they're already going to be inside these companies. And so, they will have a different, more, I think, direct supervisory way to look at what some of these companies are doing. And, if you know anything about Rohit Chopra, he's very naturally suspicious of big tech companies. He just is. And so the ability for him to get inside Apple, as an example, and to kind of poke around, I think that's probably sort of a driving motivator here.
Yeah, we haven't really talked about this, but I've actually been really fascinated by the supervisory parameter. I like to think of it as like kind of a porous border
Right.
and how regulators have used banks to enact oversight
Right.
of non-bank partners and how now, it looks like payments might be, again, a way that a regulator will be able to enact supervision. And I'm kind of just fascinated by the expansion or the shrinking of, or like, this big net of what's getting drawn in. And, the CFPB is kind of building its philosophy around like, who do consumers need to be protected from financially? And, for a while, it was probably pretty easy to determine the parties or the businesses or the industries. And now it's getting a lot harder to figure out. And I don't know if that's because in the absence of explicit regulation, a lot of non-banks started doing bank-like things, hence, why I'm even on this podcast to talk about. But, I think now there is probably more activities will be a way to get into the parameter. It is not the charter itself that puts you on one side of the line or the other.
Yeah, no, that's right. And it is interesting because like I think the international money transfers was the first one where they sort of expanded the regulatory perimeter using this sort of exemption or power that they have under Dodd-Frank. And that was the first one that kind of pulled a few of the fintech companies in, like a PayPal or a Wise or companies like that. And I think that was the first time where they're like, whoa, okay, this is how this is going to work now. And I think the CFPB, that was kind of a test balloon, and now they're going to do this. But like, there's absolutely no reason to expect that they won't find some new category of fintech or big tech that they can't quite get to with this one.
Activity.
Yeah,
stored
bank-like
value.
activity.
Guys, we had to figure out if airline miles are stored value.
I looked into it, and they were pretty careful about finding a way from that one. But there's no reason they can't go back to it,
The stored value regulation, or that would just be the craziest application to me. I
Totally.
love it when the inflation and deflation of those points happen all the time. A regulator does not need to be involved in this.
Well, can I tell you? I'll tell you this.
There is no consumer protection.
I will tell you this.
That's your fake money from your fake bank. Sorry,
right.
Go on.
No. Well, no, I mean, it's funny that you say that because in the proposal, I was reading through it and they were defining what's a consumer payment and what's not a consumer payment. And they specifically said, if it's your own stored value for a merchant that your customers use to buy stuff just from you, not from another merchant, it's not included. But they went on like a whole like multiple paragraph thing where they talked about why that still is a consumer finance thing. So it's not included in this proposal, but it was almost like they were writing it to Dick Durbin specifically. They were like, Dick, just so you know, we can look into this and we may in the future. It's just not included in this proposal. That jumped out to me as like, okay, so they might circle back to that. So if they do, Kiah, I'll let you rant about that when that eventually happens. But until then, do you want to jump us to our next story?
Okay, so this is not explicit news item. It has more of a rant, but I was reminded of it recently, in part because of a collaboration you were involved in with Simon Taylor and Jason Mikula about SoFi's earnings. And every single time I think about this, it's my number one question, which is why doesn't SoFi report their earnings like a bank? My first question we have to start out with is SoFi a bank? And so
yes, right? Like, I mean, my dumb answer is yes. Am I wrong?
Right. Well, some evidence that would support that answer includes that SoFi has a bank charter,
which
that's a big allows
one.
SoFi to access deposit insurance and gives them lending permissions and payment abilities. So by this definition, SoFi is a bank. The other question that I think might influence this answer is, does SoFi make most of their money from banking activities that come from its charter privileges? And the answer there, as far as I can tell, is also yes. Now,
lending money, right? Yeah.
Yes. Yeah. It's for most banks that they tend to make money by interest income. And so, something that I think, and something I actually want to talk to you about, since you dabble as a bank analyst now, is, banks there's 4,000 banks, 300 of them are public. They might all be a little different in size and scope, but they actually tend to report earnings in a pretty comparable way, using pretty comparable definitions that allow pretty easy comparison across banks. And so they report things like net interest income, which is the revenue they make from lending, and then not lending, which is non-interest income. They pay one of their large expenses is the money they pay on, or interest they pay on deposits, which is called their interest expense, and other expenses called non-interest expense. You can see where I'm going with this. There are many very specific ways that bank earnings are reported. And it's just one of the best things about being a bank reporter is there's a lot of banks, but they're all kind of going to use the same vocabulary set, except SoFi. So SoFi uses what I would consider non-traditional bank performance metrics or earnings metrics like EBITDA, which is earnings before interest, taxes. Is this debts? And adjustments? I don't know. I don't know what EBITDA stands for anymore because I haven't had to think about what EBITDA stands for in 10 years.
Right.
They also report a lot of adjusted revenues and adjusted income. Yeah. And then it's actually like so hard. This is so confusing to me, a bank reporter, to figure out if like SoFi makes money, like if they are turning a profit because they're using what I would call like the non-standard bank metrics. So, Alex so I'm on one side, I'm trying to, I guess, dabble on the other side. For you, is it hard for you to understand bank earnings now that you kind of do quarterly check-ins and are exposed to the vocab set?
Yeah, no, not really. I mean, it's fairly straightforward. There are definitely some things that are a little bit tricky. I would say the thing that kind of tricks me up the most, and you and I talk about this a lot, both on the podcast and not, is the like allowances and things that banks have to do more from like a regulatory and capital management perspective.
Yeah,
those things
capital's
tend to
weird.
kind of
it's
capital's
not really like earnings though, like
right,
you can just kind of ignore
yeah, it kind of it's like
sometimes.
It's related, but you have to kind of like screen out like a part of the balance sheet. So that part I'm still kind of learning, but no, the earnings stuff I think is pretty straightforward as you laid out. I mean, there are these big buckets that are pretty standard, and that you can kind of use them as shorthand for understanding like, oh, I mean, your interest expense went up. Well, that means you're paying more for deposits. Like that's pretty simple. Like we can understand what that means. And then if I'm a bank analyst on one of these calls, and that'll be the highlight of my amateur bank analyst career, is sneaking onto one of these calls and asking a question. But like, then you can ask a question like, well, what's driving the increase in deposits? Like what's driving that? And you can like drill into that. But I think the problem, as you lay out with the SoFi one, is, and I come from more of a fintech background, not a bank background. And in fintech land, metrics are very bespoke, I guess is the way I would put it, right? Like if you pick on whatever non-bank public fintech company you want, whether it's PayPal or Affirm or whomever, Moneyline, like they all have their own bespoke way of reporting their metrics. And it's almost one of those things where like they get their analysts that study their stock and make recommendations to investors to kind of get on board with the metrics they use. And then it doesn't matter if anyone else understands them at all. And
so there's like very little comparability between, I mean, it kind of makes sense for fintechs,
really?
Because there's not like a bunch, like 5 fintechs that do the same thing, the way that there's like 300 banks that do the same thing.
Exactly. Well, and then fintech companies have used so many different levers to try to get to profitability that it would be really hard to standardize. And so they end up with these sort of tricky accounting things that they do. And like, to me, one of my favorite things, and I think you have some specific examples in here, but like the word adjusted does so much work in these things.
It's carrying a lot of weight.
It carries all the weight, right? Because it's like, to use a joke that's going to hit a little close to home for me, being a father of 3, hasn't been able to work out as much as I would ideally want to. Like if I reported my weight as like pounds adjusted, like I could do whatever I wanted with that, right? Like I could be like, I'm a trim 175 pounds adjusted weight, that would be stupid.
Weight EBITDAs.
Yeah. Right. But like, that's, I mean, not to be too uncharitable to SoFi, but like, that's what they're doing when they talk about some of these things. I'll let you give me the specific metric that drove me crazy.
I think what's so interesting, I'm going to say a bunch of things that were in the earnings report that I don't know what that means. So they reported in third quarter earnings, 111 million of incremental adjusted net revenue from non-lending segments, which includes their financial services segment. And so, like, I even have a note in here, like, is the word incremental another word for quarterly? Like, is this like quarterly adjusted revenue? They cited something called the contribution margin using lended adjusting net revenue. And I don't think I've ever seen those words strung together in that order. And I don't know what a contribution margin is. Someone And so when I was researching this story, or this piece, you can actually tell exactly when I was doing it because I had to ask the SoFi Twitter bros for help, and I
Your
used
favorite
their
people,
calling card,
yeah. So
the
you
cash
use
tag.
the hashtag for SoFi, and
Yeah.
it's like the bat
And
signal for
and
SoFi bros.
I like asked, like, and I think it's hard because I actually have a lot of bias. I think SoFi should knock this off. But I asked like why they don't think SoFi reports as a bank. And so someone had to explain what contribution margin is. If I tell you what it is, it will not help you understand SoFi's earnings because SoFi is a bank and they should report their earnings
Right.
as a bank. And so, Mikulas picked up on this too when he did his little analysis of their earnings. He says, there's a desire to paint these in a better light. But when I think about the SoFi bros, so the SoFi bros are like a group of people on Twitter who are SoFi enthusiasts, and they talk to each other on Twitter about how much they love SoFi.
SoFi stockholders.
Stockholders.
Yeah.
They're not people like me who are a customer and a student loan borrower, and we're mad at SoFi. So when someone says something that might destroy any of the value of SoFi and drag their stock down, they have to come after them. Yep. So I have crossed paths with some of these people before, but I was just I asked these guys why they think that SoFi doesn't report earnings as a bank, even though they make most of their money from being a bank. And also someone was talking about unlocking alpha from SoFi. And I was honestly like, yeah, is it because they're bringing in a bunch of insured cheap deposits and they can get rid of their warehouse funding? Probably where the alpha comes from.
Big source of alpha, yeah.
It's a big source of alpha. We call that net interest margin. And so I don't know, and it's hard to take it seriously when they're like, SoFi is a next-gen financial services company. And it's like, I don't know, man. They're just like taking in deposits and lending them out. They're not like rebuilding the wheel here. They're even like, they're selling Galileo products or services to other banks. Well, we call that a fee business line in banking.
Right.
I just think it's really interesting that mega banks like JP Morgan, Chase, or like European, international banks like that have holding companies in the United States, they can all follow the same playbook. And it allows us to just have an understanding of, is this bank like being a good bank? Are they making money on the loans? Are their deposits cheap? Are their loan losses low, right? Like all of these ways that we think about banking. So a nice SoFi bro, so shout out Data-Driven Investing, shared with me that SoFi as a company might be going through a transition in identities from being a non-bank to being a bank. So before they were a non-bank, using bank metrics maybe didn't make sense. And especially if they were like selling all of their loans or like securitizing their loans. It doesn't really make sense to use bank metrics if you're not holding your loans to maturity and then rolling them off and using it to make more loans. Maybe you don't care as much about credit quality unless there's like putbacks. And so as SoFi gathers more deposits to cover more of its loan book and can get rid of some of its wholesale funding as they maybe move from a warehousing model to a hold to maturity model, and they eat their own cooking, as we say in banking, it might make more sense for them to shift their earnings. I don't know if that makes sense. Someone else pointed out to me, and I think they pointed this out as like a good thing, but they said that SoFi's 10K is like longer than Bank of America's, like by 50 pages. So Whoa. Bank of America's is by like 100 pages. SoFi's is 150 pages. I would argue that doesn't mean it's a good thing. That actually means probably there's some redundancy, complexity, over explanation, right? Like
that's insane.
Isn't that crazy? And like that is prepared on a quarterly basis, and it's someone's job. So
multiple someone's probably. Yeah.
And I find this resistance to using these ready-made, perfectly comparable metrics really interesting. The other thing is that I wonder if it is important to SoFi to be seen as not a bank by the investing public so that they can get the bank valuation or the not bank valuations, and they can benefit from the fintech valuations, which I believe have come down, but are still probably higher than banks. And so they would probably want to be valued on an earnings basis, not a tangible book value basis. So those are the two theories that I thought were most compelling. I like SoFi. I think they're one of the most interesting banks in banking, but I don't think they're a next gen financial services company that deserves its own weird set of metrics. And I want someone to, like, on a quarterly basis, break apart their earnings and then put them under normal bank earnings so I can understand them. I
Well,
think
that would
AI should do
be
that or
that
something.
would be, yeah, I mean, generative AI, they'll like just step to the plate here. No, I agree. I mean, I think the only other thing I would add on top of that is I do think that in the case of SoFi, like when they talk about being like a next gen financial services company, right? I mean, that's just, bluster. And I am a little surprised, honestly, that, and maybe they can't make this transition or they don't want to, but fintech valuations are not really what they used to be. Like they're
Yeah.
really not. I mean,
Yeah.
some of the best performing stocks, not necessarily in terms of the highs, but just in terms of like kind of chugging along, are well performing banks, right? Because people know how to value them. It's not
Right.
particularly volatile, right? I mean, like it's easy to compare. And I would think, and I've seen this a lot in fintech recently, right? Like we saw, to give a non-bank example, when Adyen lost like 40% of its value a few months ago because they had like one bad thing that they reported, like
Mm-hmm.
that's a huge problem for your company, right? Like when
Yeah.
you lose that much value in a single day, you have to completely reorient how you run your business, your hiring plans, your sort of retention and attrition plans. Like everything about your company changes on a dime when you lose that much value. And that can happen when you're building your valuation based on a tech forward multiple and
Mm-hmm.
trying to get investors to value you beyond sort of your tangible book value. I would kind of think, and maybe this is like a rant for another day, but like maybe fintech companies that actually do make the magical jump to being a bank. So this is the lending clubs and
Yeah.
SoFi's and
The
others
three
of
of
the
them or
world.
whatever.
Yeah. The ones that have made it, like, just embrace being a bank. Like you're going to have a nice, stable valuation. It's not going to fly up and down in crazy ways. You're not going to have to like bend over backwards to think of some clever story that you can tell every quarter to get investors excited. Your executives can spend less time doing press and more actually like running the business. Like it could be like a better, more stable way to build value for your customers
Yeah.
rather than like being on this merry-go-round. So I don't know. The whole thing seems really, really strange to me. And then the last thing on SoFi is I would love to get someone in a senior position at SoFi to take truth serum and tell me how the Galileo thing is going. Because that was always really weird. And it's like, if you look at their business as different business lines, it's the one that doesn't really fit. It was getting a little bit long in the tooth relative to some of its newer competitors at the time it was bought.
Mm-hmm.
It has a few very large sort of legacy customers that are using it, but I don't know that I've seen a lot of evidence of like new growth, at least in the US. I think they've been trying to expand internationally. So I don't know if they at one point referred to it as like the AWS of financial services. And like, I don't think that's true. And I don't know that strategy is going all that well. So probably didn't show up in the earnings, but that's the sort of black hole that I can't see that I wish I could.
Yeah, I do actually think SoFi has kind of embraced being a bank with, the funding, student
All the
loan
good parts.
repayment. I think they bought like a mortgage company. And, I think that's in this high rate environment, that's one of the biggest drivers of their company is the bank parts. It is just really interesting to kind of be a bank in everything, but in like kind of name. So it'll be interesting to see how the company goes forward and yeah, whether they even do keep like Galileo. I know that this is a little different. They're also a lot bigger than most banks, but a lot of banks that have at one time owned a fintech have decided to spin that fintech out sometimes because
Mm-hmm.
the expense structure, the attention, whether or not they need to hold capital against it, things like that has been, too expensive for a bank. So it is kind
Mm.
of interesting to wonder. But again, we'll see. I just want them to report earnings like a normal bank because I hate to break it to them, they are a bank.
Yes.
But
Well,
welcome. It's not that bad to be a bank.
no,
It's
it's fine.
right now, rather be a bank than a fintech, I guess.
Yeah, exactly. Come on in. The waters are
Yeah,
warm. All right, can I give you one last super quick one?
totally.
All right, so you may have seen the word escheatment popping up a lot lately. Question.
So I knew about achievement before it was cool, but so then it was like delightful to be like, well, why do you know about achievement?
That's a question you were probably asking specifically about me, who became sort of obsessed with escheatment after not knowing what it was at all. And the reason I know about it is that it's finally sort of popped up. It's a very obscure legal process. To give the quick definition, it's the legal process of transferring unclaimed property to the state when the rightful owner cannot be found. Most types of financial accounts are considered to be inactive after a certain amount of no activity from the customer. So, say 12 months of no activity, no transactions, no logging into your account. Then, depending on the specific account type and the state, the inactive accounts will be converted to dormant accounts. And that basically starts a 3 to 5 year clock where dormant accounts that still do not have any activity and they do not respond to any of the attempts by the financial institution to reach the owners or notify them that their accounts are dormant and that their property may be turned over to the state. If they don't act, then the property ends up after that period actually getting transferred over to the state. It's really just kind of a big compliance headache for banks, essentially. It's an exercise that they have to go through. Usually it's a twice a year sort of fall and spring exercise where they have to update their list of accounts. They have to do reporting to the different states. All the requirements on a state-by-state basis are a little bit different. The reason that it is popping up, Kiah Haslett, is that we are headed into a period of significantly more escheatment than we've seen in the past. And the reason for that is that if you use that 3 to 5 year timeline, well, if you rewind 3 to 5 years ago, so 2018 to 2022, that, as we know, was a period of great growth on the part of a lot of B2C fintech companies. So a lot of fintech companies in the ZERP era were out paying for Google ads and getting consumers excited and signing up consumers for accounts. And you may be shocked to know, but a lot of those accounts have gone dormant. A lot of those accounts were actually never even used, but they were opened up. Yes. And I think in particular, one group of companies that didn't anticipate this problem were all of the banking as a service banks that were partnering with these fintech companies who have the responsibility to manage that escheatment process for any dormant accounts, including dormant accounts that sit in FBO accounts from their various fintech partners. And if you know anything about banking as a service or FBO accounts, you'll know it's not the easiest thing in the world to parse all of the sub accounts in an FBO account and figure out if you're a partner bank. Well, which ones of these are inactive? Which ones of these have had transactions? We don't even control or touch any of the front end infrastructure for the mobile app or any of the other channels that a customer might use. So we can't even see when was the last time they logged in. So it's kind of created this escheatment nightmare for community banks that have partnered with fintech companies. And the reason that it popped up on my radar was that Current, which is one of the many neobanks out there, sent me a notice that they were going to be introducing an escheatment fee of $30, the purpose of which was essentially to wipe out a large portion of their dormant accounts.
Yeah, so they just debit it from the account?
Exactly. And if the account is $30 or less, if that's the total balance, it just wipes the accounts to zero.
Yeah.
And so essentially it removes those accounts from having to go through the escheatment process, which is more expensive than just closing them, right? And so Current has started doing that. I've heard of many other fintech companies getting pressure from their partner banks to go through a similar exercise to kind of clean stuff up so that they can manage this process. But this is going to be the next couple of years. I called it in a piece I wrote, one of the fintech hangovers that we're dealing with right now. So, I mean, you've known about escheatment for well before I did. How did it pop up on your radar?
I don't want to say well before. I heard about it in a Planet Money podcast, and it was it's like an old legal term for property rights. And the process by which the state can reclaim property. I was actually, I have a story, I guess, about this, but I was familiar with it because of if you think about paychecks that people maybe just don't pick up their last paycheck. So that's a really common example for where I was in my point in life was, just moving around a lot and, not showing up or not collecting my last check at an hourly job or whatever. And so it is really funny that this thing that's kind of old wonky state property tax has come up for banking as a service. It seems like the opposite of innovative. I can't believe it wasn't maybe part of the banking as a service. If you think about the life cycle of some of these relationships, you kind of have to plan for things like abandoned accounts. You probably need to.
Well, and fintech companies don't like to think about bad things. They don't think about bad things. We need a business continuity plan. No, I don't need that.
X amount more customers that you're banking as a service partner, that would translate into probably Y amount more
Totally.
achievement. And
Totally. Well, and
so
honestly, it would account for even more than you would think. Why would be bigger? Because these fintech companies are great at acquiring. They didn't turn out to be
right.
so good at like utilization and growth and retention. Like those things didn't happen as much. The acquisition was what happened.
Yeah. Yeah. So, and then like my thing is, so I have to do what the Planet Money podcast did when I listened to it, which is to encourage all the listeners to figure out if they have funds or property in escheatment. So don't just wait till current says, you know, we're going to deduct $30 from your account that you forgot about 3 years ago. You
Public
can go
service
to,
announcement. Here we go.
yeah, public service announcement. Go to missingmoney.com, which is run by all of the states that have escheatment laws in partnership with the National Association of Unclaimed Property Administrators. You can put your name into a search database, and then it tells you how you can go about claiming your property. It's not like one and done clicks. I found out that I have some unclaimed property that's worth less than $250 in Nebraska. And so yesterday I started the process of reclaiming my unclaimed property, and I could hopefully have an update the next time we do this podcast. Alex, have you had funds escheated? Are you in the process of reclaiming all the $5 you contributed to all these little neobanks?
So I always think of Jason Mikula in this respect because he's the king of this, but I have quite a few fintech accounts that have little to no money in them. And so I am sure that I have been escheated. I'm positive that has happened to me. And, you know, I've contributed, I guess, to the state of Montana's highway fund or whatever it is that the money goes to. And I'm now going to go to missingmoney.com and put in my information to find out what else I may be
I will say
in
that,
the process of being owed.
Yeah, you have to use your like phone number, or sorry, not your phone number, your birth date, and maybe your social security number, which is good because I'm sure as we've talked about, there's many Alex Johnsons in the world, and so you got to make sure you're getting your Alex Johnson abandoned funds and not some other Alex Johnsons.
I mean,
although that would also be a pretty fun scam to figure out.
It would. I was just gonna say, yeah. I mean, the fraud angle here is kind of interesting. The other thing I think, Kiah, we should make as a goal for ourselves is we should try really hard to get whoever's in charge of the National Association of Unclaimed Property Administrators to come on the podcast as a guest and just ask them crazy questions about escheatment.
Like I think it's in the Treasury Department of every state. They have an unclaimed administrator. And if you go back and listen to the 2020 Planet Money episode, I believe they talked to the Massachusetts person who she like promotes this stuff all the time. She tries to return the property.
She tries to give people their money.
Yeah.
So. Well, I heard of a story that there was a guy who had stock, and I think it depends on the type of financial account in terms of how long these periods are, and generally like investment products are a little different than other types of financial products. But for whatever reason, this person had some shares of stock. It actually might have been a safety deposit box, actually. So it might have actually been like physical shares of stock way back in the day, but it was for Apple. And he was escheated without his knowledge because I guess he moved or they couldn't get in contact with him. And the bank turned over like $120 million in Apple stock that he had bought years and years ago and had just hung on to. So there are some horror stories with escheatment, but we will leave that one there. Kiah, I am going to call a little audible here because we have made it a goal to try to keep this a tight podcast today. So, you know, people come to this podcast for the rants. That's why they come. And so we're going to skip this next one and we're going to jump right to our possibly unanswerable question. And if you don't mind, can I ask you the question?
Sure.
Okay, so I'm going to ask you the question. We're going to flip the outline around a little bit here. But Kiah, I know you have thoughts on this. Why do fintech founders believe that they can solve all the world's problems? Why does this industry have a savior complex?
This is something that I've noticed as someone who considers herself a little bit of a fintech outsider. Is I will, come across fintechs, I will come across founders, I will come across newsletters, and they will assume a premise that fintech can solve this. And I have seen this pop up in a lot of different ways, like gender pay equality. Yeah. I have seen it pop up with things like home ownership, financial inclusion. And I think those are admirable goals, but I also think that those are what we call like wicked problems or complex socio-technology problems, and that fintech should maybe relieve itself of the burden of solving for world peace, and maybe set its sights a little lower.
So what is a wicked problem? Define that for us.
Yeah, a wicked problem. Let me pull up the definition specifically. So a wicked problem is a social or cultural problem that's difficult or impossible to solve because of its complex and interconnected nature. Wicked problems lack clarity in both their aims and in solutions, and are subject to real-world constraints that hinder risk-free attempts to find a solution. And so this can look like, and I kind of hate to use this example because it's so cringe, but it's like, it can be like, why do certain countries that are less socioeconomically developed, why can't their like girls just attend school, or why don't they have wells? And then someone comes in and just like immediately like attempts to solve the problem by maybe building a well or by building a school without really understanding some of the social, economic, cultural factors at play that have contributed to the problem being evidenced as the problem that they're solving. So, complex socio-technical systems are difficult to find. They are complex. They're difficult to know how to approach, and they're difficult to know whether a solution has worked. And so I kind of think about this framework when I see, even the assumption underpinning some of these, like, well, fintech can solve this and it will solve it by X. And I always kind of find that, to me, that's kind of lacking and it's not serious, and it doesn't always seem to like solve the problem. I'm going to bring up an example that we previously talked about. So, SoFi has not fixed student lending. Yeah. It hasn't fixed how much it costs to go to college. It hasn't fixed that kids go to college without, hundreds of thousands of dollars to finance their education. It hasn't fixed that college costs hundreds of thousands of dollars. It hasn't fixed the mechanic that we use to finance college for most people that don't have enough scholarships or grants, which is loans. It just changed they kind of figured out who they can make certain types of loans to fix the actual end of the problem, which is, people graduate from school with lots and lots of debt that they can't pay off. And that is often the payments do not reflect the reality of, being an early college graduate and not making very much money and being early in your career. So it's like, I think even to think about that example and the quote unquote solution that is available in the market, to me, just, it just can't, right? Like you can't say you fixed, you kind of helped, but I think, there are many problems that come from like being in late stage capitalism, and that require an overhaul of the system themselves to be truly fixed, to not have the problem exist anymore. And so for me, if you aren't focused on new systems, it feels like you can't create meaningful change or equity or wealth. You're just really going to replicate the same systems with smaller alterations, or insert yourself in the process and just make some money off of the skim. And so I think about, like, I've ranted to you about this. I've ranted to a couple of other people. It's sometimes really difficult for me, who is kind of a cynic and also believes that most things are hard. Most problems are hard, especially when they involve people's money or the economy, that you can't just come insert yourself and be like, oh, we solved it. We figured actually the full problem. It was actually this little like crack right here. We're just going to repair the crack and everything's going to work as it should. So Alex, I don't know if I've completely rained on your parade. I don't know. Hopefully I'm not breaking any news to you that problems are hard. So
No. You're not raining on my parade. I'm a little bit of a fintech outsider as well. It's one of my
I feel like you're the most insider person I know, and so it's so funny you think of yourself as an outsider.
That's so funny. Well,
you're not like Elon Musk, but like,
no, I am probably much more of an insider than I used to be. But I do. I value things like living in Montana, and not like there are things that make me very non-fintechy, and I have conflicts occasionally with founders around some of these things where it's like, I don't really see it that way. But it is useful to try to maintain at least a little bit of an external perspective on this, because I think you bring up a really good point, right? One of the challenges with fintech, I think generally, is there's this sort of desire to frame whatever it is you're doing as being sort of life-changingly great. And I think this is a tech problem generally, not a fintech problem specifically. Sure. But, you kind of look back to like Steve Jobs when he's talking about like, this is the most important thing that's happened in the 20th century, and Yeah, and it's like a Macintosh computer. It's like, okay, I
Yeah.
don't really think it is, and it's like there's a grandiosity that has sort of formed around the tech industry that I think honestly, like if you were to give people truth serum, what they would probably tell you is we kind of have to sell ourselves that way, even if it's not true, because that's what like attracts talent and gets people excited, right? Like
Yeah.
if you work in Silicon Valley, you can make millions of dollars doing all kinds of different things. Like we need to frame to people that they're using their intelligence and ambition in a way that's good for the world. And so I think tech in general, and fintech is not at all immune to this, has this tendency to sort of attach grandiose missions and visions to relatively mundane or relatively small problems that they're fixing.
But not even that, relatively entrenched problems, historic
Well,
problems.
and I think that's the
right?
other part. I think that's, yeah, no, totally. And I think that's the other part. And I think this gets into fintech a little more specifically is when you talk about like, okay, so what are some of the problems we can solve? Well, a lot of the like most entrenched, difficult to solve problems, and I've talked about this a lot in my newsletter, like they can all relate back to money, right? Like the thing
Yeah.
that's kind of beautiful and also frustrating about fintech is it has a theoretical in to almost any problem that you could care to try to chip away at solving, because money is involved in pretty much every problem. Lack of money, too much money not working well, whatever. And so I think that's a huge part of the problem. But I also think, kind of to your point, there are just things that like, and I try not to rant about this too much, but like the Forbes 30 for 30 list was just announced, the new one today.
Sure.
And it's a very tech sort of centric way of looking at the world because it's people under the age of 30, right? And I talk to lots of fintech founders who are young. This is their first company, or this is their first company that they founded, sometimes their first job overall. And there is a very understandable, but sometimes still very frustrating lack of like context or understanding about the problem they're trying to solve. And it comes in a few different flavors, right? So one is the sort of macroeconomic societal part of it, which is, okay, like using housing as an example, you brought that one up. Like, what's the problem with people not being able to buy houses? We don't build enough houses. That's the problem.
Yeah.
And like everything else is downstream of that. And if you build an application that makes it slightly more efficient to underwrite mortgage applications, that's great, but it really doesn't fix that problem at all. Like it shaves the tiniest little bit off of that problem, but the problem itself remains and gets bigger. And the answer is you have to go to those annoying town hall meetings where all of the NIMBYs are, and you have to
Right.
shame them into not going to those until they just shut the fuck up and let us actually build more housing. That's how you solve that problem.
Yeah.
And it has nothing to do with fintech or
It's nothing
tech
to do with
or mobile
fintech.
applications or VC dollars or anything. So I think that's part of it. And then I think the other part of it is, and I'm enormously frustrated by this at all times, but there's very much of an assumption of like, well, banks must be stupid. Like if this problem's not being solved and
It's
there's a
because banks
role
don't
for
know
financial
about it.
services, yeah, like banks just aren't solving it, or they're too stupid to solve it, or whatever. And, I think I talked about this, or I tweeted about this as it relates to like the credit card industry, just as an example. Like if you think you're going to go into the credit card space and just go head to head for prime and super prime rewards hungry customers against Chase and American Express and Capital One, like you are walking into a world of hurt that you do not understand, right? Like they are enormously smart and incredibly calculated and incredibly savvy about the way that they try to win that market and control that market. It's not for the faint of heart. You have to know what you're doing to even stand a chance in that market. And I see that kind of thinking everywhere in fintech where it's like, oh, well, banks just probably don't know what they're doing here, but I can do it better. And, first of all, banks probably can't solve this problem any more than you can because it's a larger societal complex problem that has nothing to do with financial services.
It's a wicked
But to
problem.
the extent that financial services can help with this, don't assume that you're going to do it any better than banks that maybe have
Right.
already tried or have already nibbled around that area, because there is no problem in financial services that banks haven't looked at and had some pretty smart people working on. So going into it with a certain amount of humility about the size of the problem and what your contribution to it would be a nice thing to see. I totally agree.
Yeah, I don't think there's anything wrong with incrementalism, and
No,
also,
it's how a lot of problems are
better
solved.
design, but just, God, please stop trying to fix
Simmer
every
down.
single complicated problem with a
Simmer
fintech
down,
or
or
with
at least at least if you're going to frame it as like, we want to be a small contribution to
We make
solving
someone's
a
life a
very
little
large
better.
problem.
Yeah.
Right. I like that way of framing it a bit better. Okay, so that was an excellent rant. I want to give you a chance to rant about one last thing.
Okay.
This is our Kiah Go Off segment. So Kiah, just go off on something.
Okay. Well, my first question for you, Alex, is if you had to guess what the national average rate for a 12-month CD is, what would you guess that rate is?
12-month CD.
The average rate across the nation.
I don't know, 6%?
Would you believe that this week, according to the FDIC, it was 1.8%?
No.
Okay, that is. The FDIC maintains what's called the national rate cap.
Okay.
It is a survey of the national average rate charged on certain types of deposit products, including savings, checking, money market, and CDs at regular intervals. And that's my rant today is the FDIC has fixed the national rate cap, and so banks should stop gaming the national rate cap, which they are still doing. Allow me to explain.
Okay.
So before, in 2019, the FDIC fixed the national rate cap, as I said. Before, the national rate cap is a survey of the average rate that banks across the country charge on different products. It is weighted by branches. So it has an overrepresentation by large banks. And what was happening in 2019, I don't know if you remember, but interest rates were at 3%, and which meant that the Treasury was also at 3%. And banks can offer interest rates on products at whatever percentage they want. But if you are a troubled bank, you are under rate restrictions, and that's where the rate cap comes from. And that's why they calculate this survey. It's the national rate plus 75 basis points.
And the thinking on that, just to make sure I'm clear on it, is if you're a troubled bank, we don't want you going out there and using high rate CDs to bring in a bunch of hot deposits and then do crazy shit.
Okay. Yes. So, but the other thing too is like examiners will use this to say like, oh, you're offering high rates. Remember, like even a healthy bank offering high rates and using rates to attract money back before the banking crisis, this was seen as hot money. It was rate seeking money. And it was money that you would have to pay a lot of money to keep. These are not like quote unquote real relationships. But that's fine when interest rates are zero. And so the Treasury rate is very similar to the rate on CDs. But what was happening is that the Treasury rate in 2019 was at 3%, and banks were still reporting these regular intervals to be really low, because what they actually do, and I'm sure you'll see this now that I'm pointing it out to you, is they do CD specials, and they do it on non-interval regular intervals. So instead of a 6-month CD, which gets reported into the national rate cap, they'll do it on a 7th-month CD. Instead of a 12-month CD that gets reported into the national rate cap, they'll offer the special on a 13th-month CD.
That's so interesting, because I did wonder at some point when I was looking at like CD pricing, like what's with all these weird terms? Like intervals, why is it 8 months? That's so weird. Right. Okay,
That's why it's 8 months. And
tricky.
So that's called the special. So that's like the CD special. The regular CDs are just, so if you like, and I don't know because I don't run this survey, if I just looked up a random bank's website, is the 8th-month CD like 3 or 4 or 5% higher than the 6-month CD, the way that the national rate cap indicates?
So the approach from the bank's perspective was, we want to keep this rate cap as low as possible.
Well, someone wants to keep it as low as possible.
Sure.
Possibly the biggest banks. So in 2019, the FDIC fixes this problem, and they say, you know what? If CDs are similar to treasuries, we will include the going treasury rate that is comparable to the CD rate. So now there's 2 rate cap numbers. Either it's the national rate cap for like, let's say a 12-month CD, or it is a 12-month treasury bond is paying. And so
they can't get too far away from each other.
Well, yeah. And so banks aren't like, hey, you're going to have a liquidity crisis because I'm under a rate cap, but the safest asset in the world is paying like 6% or whatever. And so the FDIC fixed this. And so now a bank can offer a 12-month CD at whatever the national rate cap is, or what the FDIC said the adjusted rate yield was, which is 7.28%. So there is no reason why there should be a big delta between the reported CD for nationally, the national average,
Yeah.
and the Treasury. But there is, and this has persisted, and I don't know why it's happening still. And I lost this like kind of argument with my editor because she was talking about like average CD prices are really high. And I was like, that is verifiably not true.
It's not
based
true,
on the
yeah.
FDIC. But I think it's so interesting because she was correct too, because we all know that CD prices are high generally. But if I was going to walk into a bank and they were like, hey, do you want to do a 12-month at 1.85%, or do you want to do a 13-month at like 5%? I like that's not even a question I have in my head, right? I'm not sitting around being like 12% or 12 months, 13 months. But banks do this and they're doing it every single week. And this is so annoying. And they should just stop doing it. They should just stop doing it. Just collapse the prices. It's still happening. It was happening when you were looking at it today. Or like whatever, like recently.
That is so weird. Yeah, no, I mean, I've definitely noticed that. It's really, really strange. And it's one of those things where it's like, trying to think of other examples, but it's like people get used to gaming a system and then the system changes, but their gaming behavior doesn't change.
They can't
right?
stop.
They're just
they can't stop their little cheating.
Yeah, they're like, this is what I do. This is how I do my job. So that is a really, really good example. And I'll tell you, anything that happens that relates to like numbers being reported and chicanery around that is just going to set Kiah off. So if you're looking for like advice on like not making Kiah angry, anything that's
do you think that
or data,
as many Wells Fargo branches should count as one in this
seriously.
survey?
Seriously,
that kind of like overweighting influence is wild, because like
it's crazy.
The biggest banks have the best cost of funds pricing, and so they need to pay the least amount. So it's not like a big problem for like liquidity. Like the treasury's in there. The rate is now fine. Like the national rate cap is a market-based rate. In 2019, it was not a market-based rate.
So they fixed the liquidity part of it but
they fixed the liquidity.
The nonsense is what you're ranting
I am
about.
still like, I'm so mad that banks are still gaming
these people, whoever these like Wells Fargo deposit CD pricing people who are working in some back office somewhere, just like earning your ire right now.
Isn't it more annoying for your website to have like regular CD prices that are low and then specials that are really high?
It should be.
Weird.
Or a customer service person who's dealing with a customer and they're like, yeah, I want a CD. They're like, yeah, do you want the 12-month or the 13-month? They're like, is there a difference? They're like, oh, there's a difference. There's a big, big difference. It's a good thing you asked that question, because there is a difference. Kiah, I have one more little surprise segment for you that I didn't tell you about. But listeners of this podcast may know that on our last podcast, I uncovered a very disturbing fact, which is that Kiah had never seen the movie Groundhog's Day. So welcome to a new recurring segment that I'm just going to surprise Kiah with at uncertain intervals, which is, Kiah, have you seen this movie? Kiah, are you ready for today's segment?
Yeah. Are you ready to emotionally react?
Wow, I've been preparing all day. So this is a very relevant one because this is our December show. And this is both relevant because it's December and also relevant because of your job. Kiah, have you seen It's a Wonderful Life?
Once.
Okay.
I saw it 2 years ago. I saw it very recently.
You saw it very recently. And
I've seen it once.
What was?
And I wrote a little essay about it.
Well, okay. So I was going to ask, what was like the motivating reason
that I needed to write a topper for the newsletter?
I knew it. I knew it had to be something like that.
And it's COVID, so
okay. So you're at home, and
and like it's kind of heartwarming too. So
did you like the movie? Because you'd heard the references to it. You're a bank reporter, like you'd heard it a million times.
Yeah, I don't.
Too old?
I don't think I would say that I liked it. I was kind of surprised by the suicide ideation, spoiler alert. 2, I was really confused that there is a building association and a bank, and that the bank is the bad guy.
You are the only person who would be confused by that.
I was like, one, the bank's the bad guy, and all the bankers are like, oh, I love this movie. And I'm like, but y'all are like the bad guguys.
And then I also
had to be like, what is a building association? And I had to look up the history of building associations. There was like a podcast that also explains what a building association was. And but yes, I did like that there was a bank run. So that was really nice.
Classic bank run, yeah.
And I did kind of like the idea that like when he doesn't deposit the money,
Mm-hmm.
the money doesn't have its financial protections around it.
Right.
I kind of like that. There's a bank examiner. That's very fun. He sits in
There's
the
a
vault.
bank examiner.
So there's
Yep.
a vault. Also love that there's a vault. And I do like that it kind of explains how the fractional reserve banking system works out.
Oh.
So that was kind of nice. But I don't know if I like loved it. I don't think I would have watched it if I wasn't a bank reporter. I also have seen like Die Hard once as well.
Okay.
And I wrote last year for the topper that if Die Hard is a Christmas movie, it's also a movie about securities regulation and bearer bonds and how important it is that we don't think about financial innovation as being like the blockchain of just being like these like bonds belong to someone. But the whole movie is about bearer bonds, which don't exist anymore. And I had to look up about bearer bonds.
No, so that's a really good point. Well, okay, so first of all, I love It's a Wonderful Life.
Really?
It's not,
it's
for
so
sure.
Long.
It's amazing. It's like the best movie ever. I mean,
it's like barely Christmas movie.
Kiah, no. We can't get into this because you're just like so tragically wrong about this. I can't even spend the time to argue this. But no, love it. My feelings about it are probably rooted more in like the emotional tradition of watching it in my house than like sort of my study of it as a movie objectively. So I'll admit to being a little irrational about it, but totally love it.
Sentimental.
Yeah, I hadn't thought about all of the bank nuances the way you have. Because again, like, because I'm so used to watching it as like an 8-year-old, right? And so like I wasn't thinking about those things when I formed my impressions of the movie. But as you say that, it is a little weird that like the bank examiner and like the cops and everything at the end just sort of like tear up the warrant and all of the things and just sort of like forgive him. So that was probably not the way that they were supposed to do it technically. But again,
that's
like
not how the FDIC does it.
George Bailey had to win. He had to win. So, I mean, I think that's fair. On the bearer bonds front, we should do a whole other Die Hard thing at some point. But it was a real theme in like the 80s and 90s, like a lot of like bank heist thief type movies. It's a good
heist instrument.
Well, it's great, right? Because it's like they hold their value, they appreciate like over time. So it'll be like, you can steal a box of bearer bonds and like it's like that's $300 million or whatever.
They're just like blank checks that grow in money. Yeah,
right. Yeah. So they're kind of like the perfect vehicle for like theft. But I do think if they wanted to remake Die Hard, and they shouldn't because it's perfect, but if they wanted to, they could reframe it around crypto and have like cold wallets with cryptocurrency in a vault.
I was gonna say, wouldn't the blockchain like bust them?
No. You just have like, you have cold wallets with like a seed phrase that you have to get from Nakamoto before you kill him or whatever. Like there's a way to do it where like it could be just about like, oh, I thought you were terrorists, but you're actually just crypto thieves.
I will say that like
you could do that.
That would be a really boring movie because it would involve a lot of computers, and computers make for bad movies, like just typing on a computer.
Yeah,
that's why like
fair.
Journalist movies are kind of boring because like a lot of the work's just done at a computer.
Well, we'll have to get into that because I'm sure you've probably seen some journalist movies, but we'll surprise you with another one of those in the future.
Yeah. I'm really excited for the ones that I haven't seen. I will do no work to try to see more movies.
Yeah. I mean, don't go out of your way. You probably weren't going to anyway, knowing you.
No, I actually still haven't seen Groundhog Day. I thought about it.
This is what I'm talking about. This is what I'm talking about. It's amazing. So, all right.
I actually asked Emily, and my colleague Emily, and she has not seen it all the way through either.
No. Emily, no.
Maybe it's just you that saw this movie. Like
I swear it's not. But listeners, please at Kiah on Twitter and be like, Groundhog Day is amazing. As is It's a Wonderful
Hoodies
Life.
Are fine.
It's also Christmas movie. Hoodies are fine. Like we need to push back on Kiah Haslett. That is all the time we have. We did it a little faster than we normally do, so I think we're trending in the right direction. Kiah, we're going to pick this up in the new year. So until then, I hope you have a wonderful holiday.
Yeah, you too.
And we'll see you again soon.
All right. Thanks so much.
Thank you. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.